U.S. job market running out of steam. The U.S. job market is running on fumes, and the warning signs are flashing. Despite a decent first half of the year, the risk of employment growth slowing down is becoming increasingly apparent. The upcoming July jobs report, set to be released at 8:30 a.m. Eastern Time on Friday, is expected to reveal a net gain of 115,000 jobs, a significant drop from June's 147,000 jobs. The unemployment rate is also expected to tick up to 4.2% from 4.1%, according to FactSet consensus estimates. But here's where it gets concerning. The current pace of job growth is the weakest it's been since 2010, excluding the pandemic recession in 2020. The U.S. has added between 102,000 and 158,000 jobs per month through June, which is solid but not spectacular. However, this growth is largely driven by a small fraction of industries, leaving the rest of the job market stagnant. We're getting more and more reliant on a very small part of the economy to drive any sort of job growth. Heather Long, chief economist for Navy Federal Credit Union, said in an interview, "There just are no jobs right now, AI or no AI, tariffs or no tariffs. The main culprit behind this slowdown is uncertainty. Businesses are hesitant to hire new workers due to the unpredictable nature of the trade war and tariffs. When companies can't make predictions about the economy and therefore their operations, they tend to wait for more information." Elizabeth Renter, senior economist at NerdWallet, explained, "This has resulted in a labor market with little turnover, which is essential for a healthy economy. The latest federal data on labor turnover confirms this trend. The Job Openings and Labor Turnover Survey showed fewer job openings in June, hiring at a one-year low, and a quits rate below the 5-year average. Other indicators, such as initial jobless claims and continuing unemployment claims, also suggest a slowdown in the labor market. So, what's driving this slowdown? Long puts tariff-related uncertainty as the clear number one, followed by a continued post-pandemic normalization and rebalancing of workforces, and then the AI effect. The impact of tariffs on the labor market is not just about the numbers. It's also about the uncertainty they've caused. The unemployment rate may have gone down in June, but the size of the labor force also decreased, and participation rates fell off. The unemployment rate is a critical indicator of economic health, but it's losing its luster due to seismic shifts around immigration. Healthcare and education are the only industries driving job gains, accounting for 94% of the month's job gains in June. The average duration of unemployment rose to 23 weeks in June, and the share of unemployed workers who have been out of a job for 27 weeks or more rose to 23.3%, edging near a 3-year high. The expectation is that healthcare, social assistance, and leisure and hospitality will drive the job gains in July. However, the diffusion index of private industries, which measures the share of sectors adding jobs, measured 49.6 in June, indicating that more industries lost jobs than added them. The biggest impact of tariffs on the labor market so far is the uncertainty they've caused. While some tariff-related price hikes are starting to appear online and in stores, the biggest concern is the uncertainty they've created. In terms of reasons for drags on the labor market, Long puts tariff-related uncertainty as the clear number one, followed by a continued post-pandemic normalization and rebalancing of workforces, and then the AI effect. Wages have continued to outpace inflation, but the events of the recent months have kept the Federal Reserve on pause and brought the return of the K-shaped economy, where the have-nots are struggling, and an upper slice of the haves is driving most of the growth. People are really stretched thin, Long said, adding that continued weakness in the labor market could negatively compound ongoing stressors such as growing household debt. There simply is not much hiring, white-collar or blue-collar, she said. I'm hopeful that will change if we can get tariff certainty by the end of the summer and a rate cut by September. The U.S. job market is at a crossroads, and the upcoming July jobs report will be a crucial indicator of its direction. Will the labor market continue to slow down, or will it pick up steam? Only time will tell. But one thing is certain. The The uncertainty caused by tariffs and the trade war is having a significant impact on the labor market, and it's essential to address this issue to get the economy back on track. And this is the part most people miss. The labor market is not just about numbers, it's about people's lives. The uncertainty caused by tariffs and the trade war is affecting not just businesses, but also individuals who are struggling to make ends meet. So, what do you think? Do you agree that tariff-related uncertainty is the main culprit behind the slowdown in the labor market? Share your thoughts in the comments below. August non-farm payrolls preview, NFP expectations, dollar index trends, market impact. Brace yourselves. Tomorrow's August non-farm payrolls NFP report could redefine market trajectories, and not everyone is prepared for the fallout. With consensus expectations mirroring last month's forecast of 110,000 new jobs, traders are holding their breath to see if the U.S. labor market will deliver another jaw-dropping surprise. Remember July's shocker? Jobs smashed estimates by 37,000, landing at 147,000. A reminder of why this report is a nuclear event for global markets. For newcomers, the NFP isn't just another data point. It's a monthly health check on the U.S. job market, released alongside the unemployment rate. These numbers move currencies, stocks, and even central bank policies. If you're still fuzzy on why this matters, our July NFP breakdown, https://markets.july-nonfarm payrolls, explains how these figures can make or break trading strategies. July's wild ride, the dollar's resurrection. Let's rewind. July was a roller coaster. The U.S. dollar index, DXY, plummeted to 96.40, only to roar back to 100.00 this week, thanks to hotter-than-expected core PCE inflation, 0.3% versus 0.2% forecast. This rebound has thrown a wrench into 2025's dominant trend of dollar weakness. But here's the twist. Is this dollar surge a dead cat bounce or the start of a sustained reversal? The million-dollar question. Can the U.S. dollar index economy keep outperforming expectations as it has since 2024? The answer could delay the Fed's first rate cut, a debate that's splitting Wall Street. August seasonal job trends. A mixed bag historically. August NFPs average 160,000 jobs, excluding COVID-ravaged 2020 to 2021. But let's be real. 2020's freakish 1.8 million job spike warps the data. This time, markets are laser-focused on whether employers are hitting the brakes or flooring the accelerator. Dollar index alert. The 100.00 threshold could change everything. The DXY's 2.6% surge since last week has FX traders sweating. Our earlier analysis, https://marketpulse.com/markets/dollar regains footing as long-term reversal carves out a bottom, flagged a potential break and retest pattern from 2025's downtrend. Now, with the index flirting with 100.12, a decisive break above 100.50 could trigger a dollar buying frenzy. Conversely, failure here might revive the bearish trend. But here's where it gets controversial. Some argue the dollar's rebound is purely technical, while others see it as a bet on America's economic resilience. Which side are you on? Tomorrow's scenarios, from market euphoria to panic. Let's get tactical. 3 possible outcomes. 1. Beat, jobs 110K. The dollar rockets higher, stocks rally, yes, they're already at records, and rate cuts get pushed to 2025. Gold tanks. 2. Miss, jobs less than 110K. Dollar plunges, stocks nosedive. And traders price in aggressive Fed cuts starting September 3. In line, 110K, plus or minus 5K. A yawn fest with minor dollar stock dips before everyone refocuses on CPI data. The wild card. Equity markets are priced for perfection. A jobs beat could fuel melt-up FOMO, while a miss might expose how fragile this rally really is. Controversial take. Could good news actually be bad news? If jobs surge, the Fed might delay cuts despite inflation cooling, a scenario that could implode the soft landing narrative. What's your verdict? Pro tip. Don't sleep on month-end portfolio rebalancing. These flows often amplify volatility, turning a mild reaction into a market tantrum. Final thought. The $100 DXY level isn't just a number, it's a battleground. Break it, and dollar bears retreat. Hold it, and the 2025 downtrend stays alive. Either way, grab your popcorn. Author Spotlight, Elior Manir. Elior isn't your average analyst. With 7+ years in the trenches, including stints as a fixed-income trader at the Montreal Exchange, he deciphers markets through a rare lens, blending geopolitics, macro trends, and real-time trading flows. His insights? Think of them as a GPS for navigating economic storms. Your turn. Will the NFP cement the dollar's comeback or resurrect the bearish trend? Drop your prediction below. Let's see who nails it. Disclaimer. Views expressed are the author's alone, not Oanda's. Trading involves risk. Educate yourself before diving in. For real-time data, bookmark the Market Pulse Economic Calendar. Full terms, https://www.marketpulse.com. Terms of use. July 2025 non-farm payrolls unemployment rate. What to expect. The anticipated increase in total non-farm payrolls for July 2025 is set at 115,000. This figure represents the median forecast for non-farm payroll employment for that month. However, if the actual rise in non-farm payrolls reaches 115,000, it will signify a decline compared to the previous month's figures. Additionally, this number falls short of the average increase of 150,800 observed over the past year. In June 2025, the total non-farm payroll employment saw a boost of 147,000, which was notably higher than the median estimate of 115,000. Analyzing the trends over the last 12 months, we find that the total non-farm payroll employment has exceeded the median estimate in 6 instances, while falling below it in the other 6. Looking back over the past 5 years, or 60 months, the total non-farm payroll employment has surpassed the median estimate 55% of the time, while it has fallen short 45% of the time. It's important to note that the historical figures referenced in this analysis are based on revised data, not the initial numbers released on the report day. Turning our attention to the unemployment rate, the median estimate for July 2025 stands at 4.2%. Should this figure hold true, it would indicate an increase from the previous month and would also be above the trailing 12-month average of 4.1%. In June 2025, the unemployment rate was recorded at 4.1%, which was lower than the median estimate of 4.3%. Over the past year, the unemployment rate has exceeded the median estimate in 3 months, matched it in 5 months, and fallen short in 4 months. When we examine the last 5 years, the unemployment rate has surpassed the median estimate 32% of the time, matched it 18% of the time, and fallen below it 50% of the time. Tomorrow, the U.S. Bureau of Labor Statistics, BLS, will unveil the total non-farm payroll employment figures and the unemployment rate for July. Please note that the actual figures reflect revised data. This blog post serves solely for informational purposes. The content herein does not constitute legal, tax, or investment advice. FactSet does not endorse or recommend any specific investments and assumes no responsibility for any outcomes that may arise directly or indirectly from actions taken based on the information provided in this article.